There are rumors swirling right now that could reshape the way every Australian shops, invests, and thinks about two of the biggest names in this country: Bunnings, Wesfarmers, and a merger announcement that almost nobody saw coming. If you own Wesfarmers shares, if you shop at Bunnings, or if you just care about where Australian retail is actually heading, you need to understand what this means before the market does. Because here is the truth. Most Australians treat Bunnings like a weekend ritual, and Wesfarmers like a stock their dad mentioned once. But underneath that green and yellow shed is one of the most profitable retail operations on the planet. And a structural shift at this level does not just move a share price, it moves the entire game. So today, I am breaking down exactly what the Bunnings Wesfarmers merger announcement means, what the numbers actually say, what it could do to your portfolio, and what smart Australian investors are doing right now before the dust settles. Let us start with the numbers so you know what we are actually talking about. Wesfarmers is one of Australia's largest listed companies by market capitalization, sitting comfortably in the top 10 on the ASX. Bunnings alone generates over $18 billion in revenue annually and accounts for the lion's share of Wesfarmers' total earnings. When a business inside a conglomerate is that dominant, two things tend to happen. Either the parent company doubles down and integrates it deeper, or the market starts asking whether the whole structure still makes sense. That question is now front and center. A merger or structural consolidation at this scale triggers a chain reaction. Institutional investors reprice the entity. Retail shareholders scramble for clarity. And the media runs headlines that are either 3 steps ahead of reality or completely missing the point. Your job right now is to cut through that noise and look at what the fundamentals are actually telling you. Here is what we know. Bunnings has been the engine of Wesfarmers for years. Its return on capital is exceptional. Its store network is deeply embedded into Australian suburban life in a way that is almost impossible to replicate. When you own a business that sticky, with margins that consistent, and a customer base that comes back every single weekend, you do not accidentally stumble into a merger conversation. This is deliberate. This is strategic. And that tells you something important about where Wesfarmers' leadership sees the next decade playing out. Now here is the part most coverage is missing entirely. The broader Wesfarmers portfolio includes Kmart, Target, Officeworks, Priceline through Australian pharmaceutical industries, and a growing industrial division. Each of those businesses competes in different cycles. Some are defensive, some are discretionary. The question a merger announcement forces onto the table is whether bundling these assets together still creates value, or whether separating them unlocks more. For Australian investors, this is not just a corporate finance question, it is a portfolio question. If you hold Wesfarmers in your super through an ETF or directly, the way this plays out affects your returns. A demerger historically tends to unlock value. A deeper integration historically tends to stabilize earnings. Neither outcome is automatically good or bad. It depends entirely on the terms, the timing, and the market environment you are operating in. And right now, that environment matters more than ever. Interest rates are still shaping consumer behavior. The cost of living squeeze has shifted where Australians spend. Bunnings has actually benefited from the home improvement trend as people choose to renovate rather than upsize into an expensive market. That tailwind has legs. But it also means Bunnings is now carrying enormous expectations on its shoulders inside the Wesfarmers structure. A merger announcement changes those expectations. Here is what smart investors are doing right now. First, they are not panicking, and they are not piling in blindly. They are going back to basics. What are the underlying earnings? What does the balance sheet look like? What is the realistic timeline for this to play out? Corporate restructures at this scale take months, sometimes years, to fully resolve. The investors who win are not the ones who react fastest. They are the ones who understand the business well enough to hold conviction while everyone else is guessing. Second, they are watching the capital gains tax implications closely. With the May 2026 federal budget changing the CGT discount structure from the 1st of July 2027, any investor sitting on significant gains in Wesfarmers shares needs to factor in timing. If a structural event like this triggers a realization, the tax outcome under the new rules could look very different from what you expected 12 months ago. Talk to your accountant before you make a move, not after. Third, they are looking at what this means for the competitive landscape. A stronger, more focused Bunnings operating entity would put serious pressure on every hardware and home improvement competitor in the country. That has ripple effects across retail property, supplier contracts, and the broader consumer discretionary sector on the ASX. This is not just a Wesfarmers story, it is an Australian retail story. And here is the honest reality check you need to hear. Corporate announcements like this one create noise before they create clarity. The first wave of coverage will be speculative. Analysts will have conflicting views. Social media will run hot with takes that have no basis in the actual financials. Your edge as an individual investor is not speed. It is patience combined with understanding. The Australians who have built real wealth through the share market did not do it by chasing headlines. They did it by understanding businesses well enough to stay calm when everyone else was reacting emotionally. A Bunnings Wesfarmers merger announcement is exactly the kind of moment that separates disciplined investors from reactive ones. So here is what you can do today. Pull up your portfolio and check your Wesfarmers exposure. If you hold it directly, review your cost base and understand where you sit on capital gains. If you hold it through an ETF, understand how much weighting that fund carries and whether this event changes your overall risk profile. If you have been watching from the sidelines, use this moment to actually study the business rather than just the headlines. Because companies with the earnings quality of Wesfarmers do not come up for serious scrutiny often. When they do, that is your window to learn something that pays off for years. Wealth in Australia is not built by people who know every headline. It is built by people who understand what sits underneath them. The investors who come out ahead of a moment like this are the ones who already knew the business, already knew the numbers, and already had a plan before the announcement hit. Now you have a clearer picture of what is happening and why it matters. The next move is yours. If this video gave you a sharper lens on what the Bunnings Wesfarmers announcement actually means for your money, hit the like button. Subscribe if you are not already here, and turn on notifications because this story is going to keep moving, and you will want to be across every update as it comes. I will see you in the next one.